Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of corporations. Today we're diving into the 10K report of BioRegenx Inc., a company that promises health and wellness through supplements and technology. But spoiler alert, it seems like even miracle pills can't cure a balance sheet from looking a little sickly. Let's see what's really going on behind the scenes of this Nevada-based company. First off, BioRegenx is no stranger to change. Originally Find It Inc., they morphed into BioRegenx after a merger in March of last year. This wasn't just a name change, it was a complete overhaul, swapping shares and bringing in new leadership with promises of attracting big investors. As part of the change in direction, the company brought in DocSun Biomedical Holdings and Find It AI Connect under their umbrella. It's like they're trying to build a wellness empire. They own DocSun Biomedical Holdings, which has some interesting AI tech that they say can estimate your vital signs just by scanning your face. They are building their AI engine using optical coherence tomography. DocSun even has a deal to test its tech in electric vehicles to check in on drivers' vitals. But the big money is supposed to come from licensing their tech. Microvascular Health Solutions, another subsidiary, focuses on, according to their name, microvascular health. They produce Endocolix Pro, a dietary supplement, and GlycoCheck software, claiming these can improve your tiny blood vessels. BioRegenx is operating in the telehealth and anti-aging markets. The telehealth sector is expanding quickly and will be worth almost $800 billion by 2032. They're going after everyone from research institutions to your average consumer. Sounds ambitious, right? Before we get to the numbers, let's quickly talk about cybersecurity. They recognize its importance, mentioning that their IT director is in charge of cybersecurity. While they state they haven't had any material cybersecurity incidents yet. It's something they're keeping an eye on. All right, let's get to the numbers. Buckle up. Looking at the balance sheet, the most important part, we immediately see there's less cash on hand, about $58,000 compared to $12.51 for September, $25,000 the year before. Accounts receivable are also down along with inventory, meaning they're not selling as much as they used to. This isn't exactly the kind of health boost we'd expect from a wellness company. Total assets have shrunk significantly, about $500,000 compared to almost $900,000 from the previous year. It seems like their liabilities or debts, however, have ballooned to almost $4 million, leaving them with a huge stockholders deficit, a negative net worth of over $3 million. It's a financial hole they need to climb out of, and fast. The statement of operations, or how much money they're making, isn't much better. Net sales are down by almost a third, which is a huge drop for 1 year. Their cost of sales has gone down too, but not enough to make up for that massive decrease in revenue. They did reduce distributor incentives, which is money paid to distributors, but that's only because they are selling less. Operating expenses are through the roof, partially due to amortization and impairment expenses, a fancy way of saying some of their assets lost value. It seems like the initial excitement over what DocSun brings to the table might have been a little overblown, since they had to write down the value of this intangible asset. Interest expense has also climbed, so all the debt they took on is starting to weigh them down. All of this adds up to a net loss of over $23 million. The previous year, that net loss was about $3.6 million. Looking at their loss per share, it went from 1 cent to 2 cents, a 100% increase in losses in a single year. Cash flow is also a mess. Operating activities, their core business, used up over $300,000. Their purchases of property and equipment also took a hit. They're using more money than they're bringing in, which is not a good trend. They're taking on even more debt. The statement of cash flows highlights the need to borrow in order to operate, which isn't a sign of a business in good health. It paints a picture of a company struggling to stay afloat, relying on debt and potentially overvalued promises. They also have loans and interest due to related parties such as officers and directors of the company, which creates a potential conflict of interest. They have a lot of debt from loans. A few are in default, and it seems like they depend heavily on loans from related parties, such as their officers and directors, to stay afloat. The notes have high interest, some over 15%, increasing their costs. Here is the scariest part. They themselves admit they aren't sure about their ability to stay in business. They say that their ability to continue as a going concern is contingent upon getting additional financing and achieving profitable operations. They also admit that they may be unable to continue operations in the future. Looking at where their revenue comes from, we can see most of it comes from the United States, accounting for almost 90% of total revenue. In terms of sales, about half of it comes from their customer and direct sales and half from medical and academic. There's no single customer that is paying all the bills. Remember DocSoon and its AI engine we talked about at the start of the video? Well, it didn't work out that great for BioRegenx. They acquired the technology by issuing shares that were valued at over 10 million. After a year, they have now impaired the value of the asset, writing down its value significantly. It shows that tech acquisitions don't always go as planned, and it's really important to get the evaluation and projections right. Similar story on the merger with Findit. All that value they hoped for with the merger didn't materialize. They had to impair goodwill, which is the premium paid during an acquisition, indicating the asset isn't as valuable as they hoped. As with most public companies, BioRegenx has a code of ethics that is publicly available. It does raise some eyebrows, though, that there have been significant legal fees with their counsel that included a member of the board of directors. That seems too close for comfort. The company also grants a lot of warrants and options to employees. However, the history of these haven't been great, as these grants resulted in over $2 million in losses in a single year. So in short, the operations don't pay and equity does not retain value. Lastly, this all comes back to governance and independence. The board needs to be independent and have the right amount of expertise. The company does seem to recognize this, as they brought in an independent director and financial expert. BioRegenx's report is a complex story with an unhealthy ending. The company's revenue is significantly down. They have massive debts that they can't pay off, and they depend on very risky financing options, including related party transactions. Furthermore, acquisitions have led to impairments and not success. They operate in high growth sectors, but it remains to be seen whether they have the governance, financial strength, or the team to make it. There are definitely big questions on whether this company can last, given the current business trajectory. Doggons for watching. If you enjoyed, please subscribe, like, and comment.